Welcome back to another episode of What's on Your Mind, a show where I sit down and talk to ITPM senior trading mentors about what they think matters in the financial markets right now. Today on the call, I've got David Perlin and Anthony Iser joining me. Gents, welcome back to the show.
Thank you, Chris.
Great to see you. Hi, Anthony.
Hey, David.
I think we'll just jump straight in this time. The last few weeks, or this month certainly, it's interesting. The Bulls have outperformed the Bears, or overcome the Bears. But let's jump straight in with some of your thoughts, David. Why don't you kick it off for us today?
Yeah, I'm happy to. Good morning or hello, everybody. The market's bent, but it didn't break. And, you know, there were plenty of people, particularly in our line of work, who were calling for the end of the cycle and a bear market, and they've been proven wrong again. So again, it proves how difficult it is to time this market, and how kind of a foolish errand it is to say that the cycle's over. We'll know when the cycle's over after it's over. And in the meantime, we got to be talking about stocks, which is what we do at the Institute. As I'm speaking now, Super Mario is hosting his final press conference, and doing whatever he can to help Europe get out of its low growth morass. And obviously we have a Fed meeting next week with an expectation of another cut. It's interesting. We've never had the Fed publicly being called boneheads and other names by the free world's leader, but that's the environment we have. And under that heading, tweets matter. Trump declared last night that he's granting a 2-week tariff delay as a goodwill gesture ahead of the Chinese event. And the markets are basically right back at highs. So tweets matter. Money's got to go somewhere. So let's talk about some stocks. The other setup, which I think is really interesting that we've just experienced, and is kind of heroic in its absolute moves thus far, is the rotation, particularly in U.S. markets, where growth has underperformed value for the first time, substantial underperformance for the first time in many years. And small caps have caught real momentum too. Obviously, those are more value-oriented in general. Wall Street experts like JP Morgan's chief quant research head thinks this trade has legs. Even if he's wrong, all of us doing work on cyclicals, banks, energy, and small caps makes sense, particularly at this point in the market cycle. The fancy word for this concept is factor investing, where you take specific factors, macro factors, and attributes of specific industries and do your work and create a watch list and an investment list. Goldman Sachs Investment Research late last night posted how dramatic this shift has been. This is basically a top 1% switch in performance in the last 2 weeks in U.S. markets, which is dramatic. And even if this value rally doesn't persist, historically this does mark an intermediate top in momentum stocks. So that's just something to keep in mind, because all the big growth tilt in the U.S. might be subsiding for the time being. The other big macro call or view is that the biggest one-way trade of the year has stalled, which is that yields stopped going down. And not shockingly, this correlates very, very significantly to my previous point, where value is starting to outperform growth. So we all know how good a news that's been to the banks, and those have been some of the sectors that have particularly led us in this swap. Now, one of the things you have to keep in mind is that even with a violent swap or switch in factors, the overarching index is healthy, and that's why we're approaching highs again. I don't, in my humble opinion, believe we're going to blow through highs, but let's start thinking and identifying sectors and stocks that make sense given the switch in emotion and interest. The last thing I want to introduce today, which is something I've touched on in previous What's in Your Minds, is that this has been a fascinating year in the IPO market, especially in the US. with all these countless quote unquote unicorns coming public after a long gestation in the private markets. And who would have guessed going into this year that a meatless burger stock would be the highest flying IPO versus all the tech-oriented and car sharing apps and services that came public this market this year. So I will be featuring along in that arena, in the IPO arena, and this will be very familiar to you. But I do want to transition to specific stocks, and owing to my overarching point that we should be doing work in cyclical and some value. And one stock that I've come up with is EMCOR, which is a U.S. construction engineering firm. What I like about it, it's thematic versus my big overarching macro point. It's U.S. focused. Almost all the revenues are U.S. based. It's a top 10 holding in the IWM. Just to remind you what that ETF is, that is the Russell 2000 ETF. So you get rotation into cyclical, which is what's happened over the last 2 weeks and probably will at least stay that way. It's also a major holding in the Russell, and that is finally rallying and breaking out. So I got two themes that are supporting my long. I also get some upside into the only bipartisan discussion in DC. Democrats and Republicans cannot agree on anything. It's a death match. But one thing they can agree on is infrastructure spending. And if in fact that happens, EMCOR and other companies like it will benefit. Lastly, technicals. With some ETF inflow help, the stock's going to break out. I see a 16 PE, 15 forward, next year's PE, PEG ratio of 1, and a very conservative debt to equity ratio of 1.5. So not over leveraged, and is thematically touching all the points that are working right now.
That's great. I think it makes a lot of sense to keep a watchful eye on factors and then try and take advantage of that rotation. What about on your side, Anthony? Does that kind of agree with your general outlook? And are there any specific longs or shorts that you're looking at within that scope?
Well, it does and it doesn't. I definitely agree with David that that big rotation from growth to value is something to watch, and it's been a one-way street for a very, very long time. So if that does continue, then there's probably quite a long way for that to unwind. And one of the things it does mean is that you probably look to some of the safer emerging markets out there as well if you're looking on a global basis, because for the very same reasons, the emerging markets have underperformed developed markets, and the value proposition there is quite strong. And the smaller side of companies is another area, as David mentioned, that we'd want to start looking. So I've got one that I've been looking at. It's actually sort of come through some of the mentees flagged this one a little while back, and it is in software, so it is in a growth company in a growth sector, but it's on the smaller side of things and taking market share quite rapidly. So the company is called Rapid7. The ticker is RPD, and they provide analytics for IT security. And whether it's your home PC or you work in a company, everyone knows how vital this is at the moment. These guys don't do home PC stuff. They're enterprise sellers. They sell to companies. They have cutting-edge technology that analyzes systems, it analyzes data, and analyzes user behavior as well as one of the key components of their offering that allows people to detect compromises and potential compromises, or organizations, I should say, to detect these before they have been breached, and then go on correcting those underlying causes. And this platform's led to substantial growth for the company. Now, again, working through the Institute's process, if we have a look at the EPS growth, we can see it's pretty spectacular. 100% last year, 100% this year, coming 600% the year after. Now, much of that, those extreme numbers are because the company is transitioning from loss-making into profits. And when you go from losing 10 cents a share to making 1 cent a share to making 10 cents a share, you will see these huge EPS growth numbers. But there's a bit of a balance just to see how strong the underlying business is. The revenue growth is also very strong, 31% and 23% for the next year or two. Now that compares for its peer group or to its peer group. EPS growth is 15 and 24%, and the PE's, the revenue growth is 16%, so half what Rapid7 is achieving. And one of the key components that makes this company look very, very attractive is recurring revenue. And if you look at SaaS businesses or software as a service, one of the big moves has been to subscription-based models, looking for recurring revenue that's not reliant upon contracts. And they've got 46% growth in their annual recurring revenue, which is a very, very strong number. And 87% of their total revenues are recurring. So this is something that we find particularly attractive with this company. And so forecast numbers are equally strong, greater than 30% in annual recurring revenue forecast next year, and revenue growth of, as I said, of in excess of 30%. So how are they doing these sort of growth numbers, which makes it so attractive? Is there underlying fundamentals that we can fall back on and analyse? And they're doing it via customer growth, as you would expect, and increasing customer growth. So we're growing at 11% new customers last year. That's changed up to 14% this year, and we expect it to grow again. But the key thing for software businesses and SaaS businesses is that we want to increase the revenue per customer, because to acquire a customer in an enterprise business requires sales teams, it requires time and effort. If we can increase the amount of revenue per customer, it's a great way to grow the top line, but more importantly, the bottom line quite rapidly. And they've been doing an incredible job at this, and they've increased revenue per customer from $20,000 a year to $34,000 a year over the last 2 years. And as I said, the recurring revenue, now 87% with the subscription-based model, is continuing to provide comfort that model's working, and they can upsell and cross-sell to their existing client base. And there's lots of avenues that they do see with this, and device vulnerability is one of their key growth areas, software vulnerability, and as I said, user behavior analytics is a key component of their business and a key driver of their growth going forward. So it's a theme that sits very well with me and should with most people in the market. I think cybersecurity issues are not going away. They're becoming increasingly common. The costs of issues are becoming more public, as we've seen with some of these big breaches in recent times. The numbers are astronomical. So to avoid these costs, people are very, very happy to pay for cutting-edge systems, and that's what's happening here. So the stock has been up strongly over the last year or so, up about 60%, but with the recent pullback in some of these growth names, it's pulled back more than sort of 20% from its recent high. So I just wait to see things bottom out on this front, to see the momentum turn a little bit, but I think this one looks quite good.
And is there anything that you'd be looking to kind of put against that as a hedge, or is that more of an outright play?
I actually would probably look at this as an outright play if you wanted to hedge within the particular sector. So looking for another security name, I think the whole sector is going to do very well. If you did want to hedge it out, there is an ETF called HACK, H-A-C-K, obviously. That is a cybersecurity ETF, is the perfect hedge within from a sector point of view. But I would be inclined to let it run. or maybe look at a software company in another sector, or even a high growth stock in another sector. And yeah, so I don't have any short stocks in those sectors, but David, I suspect you've been looking around the short side of things in some of these names. Anything that on the software side that would stack up as a hedge against this one?
Yes, thanks for the tee up. I am absolutely ecstatic to be short Oracle versus you're long.
Okay.
Or CL, everybody. And it is a big cap tech stock, but not the same growth as some of the other big cap tech stocks that we all know and love from several acronyms. So it's not as an exciting tech leader as others, and it's not enough of a value stock to benefit from this rotation that I've been highlighting. So how does, Oracle is a software, not as a service, software sales company. All these companies have tried to transition to SaaS companies. In some parts of their business, they've been successful, but Oracle's not been as successful as Microsoft has been to become a truly SaaS growth type company. Oracle has gotten huge through acquisition, and that strategy continues. So organic growth has never been that big a part of the story. And they've kind of lost their luster to newer big tech, and also to Microsoft and others, which have been able to pivot to this new framework of SaaS-oriented selling. And lastly, for the fundamental kind of competitive framework, they're really an also-ran in the cloud business, and the market is appropriately fixated on cloud as a growth story. It's all tied into the SaaS, this SaaS kind of pivot that all these companies and individuals are using. I can't run my business nowadays without several SaaS providers, and all of my business is housed in the cloud largely. So Amazon, far and away the leader, Microsoft and IBM fighting for second and third, and Google spending a lot of money to be more than an also-ran. So Oracle's kind of getting edged out after spending a fair amount of money to be relevant in the cloud business, and I'm not sure they're going to get there. So that's the backdrop. They announced earnings the other day, a day ahead of schedule, and the reason why they kind of jumped the gun is their CEO, Mark Hurd, has declared that he needs to take a medical leave. So here's a company with distracted leadership. You've already had earnings. Stock was down a bit, and I don't believe it's going to go anywhere. I'd rather be long something that has some juice, like Anthony's name. And lastly, the chart to me looks like a perfect kind of freshly formed Head and Shoulders. Again, stats, 19 PE, 14 forward, a PEG of 2, and a very high debt to equity, 2.6. Again, it's grown by acquisition. It's not shocking that they have a fair amount of debt on this company. And in addition to spreading it with Rapid or a stock like it, you could throw in DocuSign or Dropbox or even CRM if you want big cap SaaS-oriented growth tech. And CRM's been down for a couple of weeks. It might be a good swap there as well.
Well, I've got another software company on the growth side of things, David, that you could potentially put on the other side. Again, it's a small cap. Looking through some of these small cap names, as you mentioned, that's where some of the value shows up. So even within growth sectors, the small cap names tend to get a little bit left behind at times. So it's a company called Paylocity. This is a cloud software company that does payroll, HR systems for small and medium enterprises, predominantly 50 to 1,000 employees is their predominant target market. And they'll do benefits administration, your healthcare, or your sort of time and employee management, your labour costs, talent management, including internal surveys and anything to do with your employee function. And so they are, again, a little bit more cutting edge than many of their competitors. They've got processes that allow employees to complete many of their own HR functions, which allows companies to reduce their HR costs because they can reduce the staff there and things become a lot more automated. And to the point where these work on mobile devices, even if you're in a sort of largish company, you can still do many things there. On the numbers side, again, it sort of stacks up on the growth side of things. The EPS growth is mid-20s for the next couple of years. The PE is currently 60, mid-60s. That'll drop to 50 the year after, and then further again. The competitors' PEs are in the mid-20s, and the reason for that is they've got single-digit growth, and they are struggling to catch up. And there's a couple of reasons for that, and I'll get to it. One of the other things about this company, as I said, they've got mid-20s EPS growth and revenue growth, and they've had 10 straight quarters of that where they have not only achieved mid-20s growth, but they've beaten guidance, beaten guidance and expectations in each of those last 10 quarters. Margins are growing, 28.7%. They're targeting 30 to 35. And have given indications once they add new products and new clients. And again, it's a SaaS model. They're adding new customers, but they're adding new products to sell to their existing customers and lifting that revenue rate per customer quite strongly. They'll look to increase that target margin number again once they get there. And they've been increasing customers quite well, 21% increase in customers to 22,000 customers. Again, they're dealing with 50 to 1,000 employee type businesses across the US and entirely based in the US. And the reason why they're not really looking elsewhere is they've got a huge market opportunity here. There's hundreds of thousands of customers in this market. They are ramping up their sales force, which grew by 25% last year, and they'll grow it by something similar this year. So they're reinvesting in their growth, which again is something as the type of growth company that we do want to see, where the opportunities are so big that they'll just keep reinvesting. And one of the reasons they are is because they're winning customers from their competitors. So they're retaining the vast majority of their own revenue. 92% of their revenue is retained year to year and is recurring and growing. 50% of their new customers are rolling off competitor systems. And to me, that's quite attractive when you've got a small player in a market that is managing to pull people off other systems, because it's not an easy thing to do, even if you're in a company of 50 people. But if you're 1,000 people, to say we're moving from one HR system to another is quite a big decision. So if people are doing that to the point that 50% of the new customer growth is coming directly from competitors and the rest coming from people who are using their own in-house systems or new company formations, that's a pretty good sign to me. And their competitors are big. ADP and Paychex are the two big players in this segment, and they have 20 to 30 times the customers. So there's a huge opportunity for these guys to really dig into this segment. And as we've talked about, investing and reinvesting in profitable businesses is what we want to do, and that's what these guys are doing. They spend 15% on R&D each year, reinvesting that capital. Paychex, on the other hand, it's a company that's been around for almost 50 years. They earned $2.86 last year, and they paid out $2.46 in a dividend. They've got a different focus here. They've got a nice yield, and they've probably got some long-time investors who are very pleased with that. But by not reinvesting in the business, they're starting to lose customers, and then we think that'll continue. And ADP is the same. They've got a payout ratio well in excess of 50%, which indicates they don't see the opportunities, or certainly not reinvesting in the business. So again, this is a company that's come back a little bit from its recent high, but not too much. Recently reported as well, and I would feel quite comfortable just waiting for that little bit of momentum to turn around in the market action and having a good hard look at this one. These SaaS businesses, when they get them right, can exhibit great growth, and I think Paylocity is going to do that.
Yeah, that's really, really interesting. I like that they're kind of managing to steal customers, because it's not easy to take them from the big players. And like you said, it's a big decision for companies as well. Let's switch back to you, David, because you mentioned at the beginning of the episode, I think, that you had an IPO name that we might have heard of before.
And I might have tipped my hand a bit and said, it wasn't going to be Beyond Meat. So what I love here, and this setup is like classic mean reversion, and just waiting for a company to kind of get their act together, is Uber. So that's my IPO long of the day. I think it's an easy 6 month to 1 year trade, and I don't really care where the overall market goes. I think this is going to be a win. And I bet all of you have either Ubered somewhere this week or gotten a Big Mac delivered by Uber Eats. I mean, it just touches so many people so many times a day. So let's talk about the reality. The IPO and post-IPO trading have largely been a disaster. But you know what IPO this reminds me of? Similar characteristics, big follow-up and enthusiasm going into being public, huge user base, gigantic brand, obviously tech-oriented, gestated in the private markets well beyond what traditionally used to be happening. And that stock, ladies and gentlemen, is Facebook. So I'll roll back the clock for you. Facebook had probably the most disastrous IPO in history, never mind memory. Technology snafu on the NASDAQ, mispriced by the investment banks, and never ever achieved actual IPO price for months. At least Uber traded at IPO price for a moment or two before falling. So both of these companies with huge expectations share an embarrassing kind of start to their public lives. And what happened to Facebook was it took them about 2 quarters to figure out how to talk to the public market and deliver what the public market wanted, which was a path to profitability. And since they figured that out, primarily by pivoting to mobile, it's been a juggernaut. Undeniable. There's a reason why FANG starts with an F. And that's exactly what Uber is going to do. It won't be long before they figure out their path to profitability. Largely a duopoly in America with Lyft, largely a duopoly or one of 3 and always the number 1 or 2 player internationally, all the big cities, all the right places. The company is on a roadshow right now, which I have been privileged to get some notes from. They're very articulate about what they need to do to get to profitability, and they're starting to rationalize, with Lyft's help, because Lyft has to be complicit in this, especially in the US. These companies, as public companies, have to stop subsidizing ride cost. That's how they get to profitability. That's the straightest line to it. They have a great team in place. This is going to happen soon. And the other kind of hangover from the IPO was that it cost them so much money to go public, and they gave a lot of stock to management, a lot of stock to their drivers as kind of a reward for sticking with them in the private market for so long, that the market kind of, or the general public, hasn't appreciated how that's put a dampener on actual results released. So I think all of this is lining up to be a stock that's going to surprise on the upside, that's going to have much more clarity, and it's going to get the enthusiasm of institutional investors who are looking for growth again. I think this is going to be a must-own stock. So what do I want to do? I want to call spread. So I can look out to March 2020. I can buy a 40 strike and sell a 45 strike call for around $1 of net premium. So I've got all kinds of leverage for a very reasonable premium. It gives me time to get the stock right. It gives me 1 or 2 quarters, maybe 3, to see some of this migration to profitability, which will be borne out and where analysts will get excited. And the stock, importantly, hasn't traded up through 45 in its public history yet. So I think that's why I'm comfortable selling the 45 strike. I can obviously take that off and just be long calls or swap into stock or some combination thereof. It gives me a lot of time and a lot of options. The other encouraging fact about this company is that both Uber and Lyft traded higher yesterday, and yesterday was 9/11. A California law was passed that deems gig economy workers, also known as drivers or temps, as employees. What does that mean to Uber and Lyft is that people that were considered just freelance temporary people, they have to, at least a percentage of them, be counted as employees, which is obviously a much more expensive conversation and concept for both Uber and Lyft and any other company that employs temp workers in California. Now, what happened to the stocks? They traded up. So I love seeing that pattern where the street's been tracking an idea or a threat. It happens and the stocks trade up. They're going to manage this. They're going to figure it out. They're going to fight it as much as they can. But just because it's happening in California does not mean that every city or state in America is going to deal with this. And they're going to find a way to interpret that most of their drivers are part-time and truly not employees. So, not a bad news, good news situation. Also, another wrinkle. Again, we're not in the business of calling a recession, and I'm not going to time one. But what I can say is if, in fact, we hit a recession, Uber is actually going to benefit. And what I mean by that, or what I interpret as a benefit to them, is that one of their biggest challenges is finding enough drivers to grow their business, and to have a reasonable cost to that employee and into that employee or temp. And when and if a recession hits, I assure you there'll be many more people willing to drive for Lyft and Uber to make ends meet. So I think that's one of their largest challenges now in a good economy with a tight labor market will become an easier thing for them to deal with. And I don't foresee a big drop off in ridership, even in the recession. Arguably, people will substitute for car ownership. And that, my friends, is why you got to be long Uber.
Great stuff. Well, we better finish up there, I think, for this episode, gents. We're just about out of time, but that's 5 fantastic stock ideas that you've talked through today. So thank you very much for both coming on the show and sharing those ideas with us today. Now, for you guys watching, I just want to point out a couple of things in terms of news from ITPM coming up in the near future. So we've just opened our November intake for mentoring programs. So if you're interested in doing a mentoring program with us, with guys like David and Anthony here, or any of the other senior trading mentors that you see on What's on Your Mind, then do get in touch with us, whether it's via the website or I'll put a link below at the video in the description as well. We've got VIP lunch opportunities to take advantage of as well, where you can go to lunch with the senior trading mentors that you see on these episodes. That's a good way to kind of meet these guys in person before you then go on to doing a mentoring program with them. So we've got a couple coming up in Singapore and Sydney later this month, but also various others around the world later this year as well. And 2 webinars as well that I wanted to point out. One that I pointed out in the last episode of What's on Your Mind, which is an alumni-only webinar. That's on the 14th of September, hosted by Anton Creel, and it's called Getting Over the Hump. And also another one called How to Make Big Returns from Brexit, so very topical at the moment. That's with Jason McDonald and Chris Cathy, hosted on the 26th of September. So anyway, that's it for this episode. I hope you guys enjoyed the show, and make sure you join us next time for another episode of What's on Your Mind.